Imagine you are walking through a really dense forest, right? And stretched invisibly across your path is a tripwire.
Oh man, a very expensive tripwire.
Exactly, because sitting just beyond that wire is a staggering $1 billion. And I don't mean a million, $1 billion in forced liquidations.
Wow.
Yeah, just waiting to be triggered if the price of Bitcoin hits exactly $76,000.
It's insane to look at.
Right. That is the mathematical reality of the cryptocurrency order books at this exact moment. But, the billion-dollar question for anyone looking at those charts is that $76,000 mark a genuine path to life-changing profits? Or is the market setting a massive, devastating trap designed to wipe you out?
I mean, it is the ultimate high-stakes psychological test. When you look at the raw data, the tension in the market is just palpable.
Oh, for sure.
The institutional forces at play here, they are calculating every single tick of the price, and they are absolutely not leaving things to chance.
Which is exactly why you are here. Welcome to Bitcoin Deep Dives by My Crypto Paradise. Consider this space your safe haven from all the chaos of the charts.
Definitely.
If you are listening to this, you are part of an exclusive, protected family. And we do not let our family members walk blindly into billion-dollar traps.
No, we don't. That is not how we operate.
Our mission today is to dissect and decode the latest incredibly urgent market breakdown from the Paradise team's lead trader, Simon. We are going to make sure you are standing on solid ground while the rest of the market is, basically sliding on ice.
Yeah. And to build that solid ground, we have to look way beyond the basic green and red candles. We are going to decode the underlying behavioral psychology of the market.
Which is where the real edge is.
Exactly. We will explore the hidden cognitive biases that cause the masses to consistently hand their capital over to the whales. And we will contrast that destructive gamble mindset with the calculated, cold, professional strategy that the Paradise team employs to thrive.
Okay, let's unpack this, because we first have to understand the actual mechanics of the trap itself, right?
The actual gears turning behind the scenes.
Yeah. To grasp how a $1 billion squeeze functions, we need to break down the dynamic between the predators, the herds, and this illusion of safety. Simon's breakdown heavily highlighted the recent price rejection at $74,000.
Which was brutal.
It really was.
Yeah.
It didn't just quietly bounce off that number. It formed what technical analysts call a bearish shooting star candlestick pattern.
For anyone trying to visualize what that means, a shooting star is incredibly telling because it is a physical footprint of a behavioral war.
Right.
Picture a vertical line, a massive long wick stretching up with a very small, thick body sitting all the way down at the bottom. What that physical shape actually represents is a brutal battle where the buyers, the bulls, threw everything they had at the market.
Just massive enthusiasm.
Exactly. They aggressively bought market orders, pushing the price higher and higher, convinced a breakout was happening. But the absolute second they reached the top of that wick, the bears stepped in with overwhelming force.
They just crushed it.
They absorbed all that buying and violently crushed the price back down before the time period could close. It is a visual representation of the buyers completely exhausting themselves.
What makes that rejection even more insidious, though, is how the big players, the whales and the institutions, they actively manipulate the order books to manufacture that exact exhaustion.
Yeah, the spoofing.
Exactly. Simon pointed out a heavy amount of spoofing around these levels, and I think the best way to understand spoofing is to imagine you are sitting across from someone at a high-stakes poker table.
Okay, I like this analogy.
Right, so they aggressively shove a massive mountain of chips into the middle of the table, glaring at you, just to see if you flinch and fold.
You start sweating bullets.
You sweat, you second-guess your hand, but the absolute second you call their bluff and reach for your own chips, they yank all their money back off the table.
In the crypto markets, whales execute that exact bluff using algorithmic trading bots.
Yeah.
They place massive fake sell orders high up in the order book. These are imposing sell walls that print on everyone's screen, designed entirely to terrify retail traders.
Because it looks so intimidating.
It does. The average trader sees this colossal wall of supply and panics, thinking they need to sell before the whale does. But as soon as the actual price gets within a few dollars of that wall, the algorithm cancels the order in a millisecond.
It just vanishes.
It vanishes. It was never real. It was a psychological weapon, a mirage designed to herd the retail masses into making an emotional decision.
But, and this is the crucial distinction in Simon's analysis, while there was a lot of phantom spoofing going on, There was also a very real, very dense $43 million sell wall sitting exactly at $74,000.
That one was not a bluff.
No, it wasn't. When the price hit that specific wall, the whale didn't pull their chips back. They held the line. They used that $43 million to act as a sponge.
Soaking it all up.
Literally soaking up every single dollar of retail buying pressure, which is exactly what forced that shooting star rejection.
What's fascinating here is the behavioral science behind why the herd consistently gets trapped against these walls.
Tell me more about that.
Well, human beings are biologically wired with a profound herd mentality. From an evolutionary standpoint, we feel safe when we are gathered together, doing exactly what everyone else in the tribe is doing.
There is safety in numbers, right?
Exactly. In modern trading, this instinct translates to placing our stop losses and our liquidation points at very obvious round numbers or clustered tightly just below recent price action.
We think, oh, everyone else is putting their safety net here, so it must be safe.
Subconsciously, yes. But the smart money, the institutions, they operate as predators, and a predator always hunts exactly where the herd gathers.
Wow. So when those retail traders panic at the spoof walls and place their safety nets right below the current price, they leave a mathematical footprint on the blockchain.
They show their hand entirely.
Yeah. If you look at the liquidation heat map Simon pulled, that footprint forms a massive glowing cluster. Right now, there is that billion-dollar cluster sitting above at 76,000, but pushing up to grab it is incredibly difficult because of that heavy institutional resistance.
Right.
Meanwhile, the space directly below the current price, it's completely saturated with the herd's long position stop losses.
And we have to break down the mechanical reality of what happens when the price drops into that saturated zone.
Let's do it.
When you are heavily leveraged on a long position, meaning you borrowed money to bet the price would go up, and the price drops to your liquidation point, the exchange steps in to protect its own capital.
They don't care about your trade.
Not at all. The exchange forcefully closes your position. To close a long, the exchange must automatically execute a market sell order. So liquidating a long position instantly creates new, aggressive selling pressure on the order book.
It creates a self-fulfilling prophecy. One person's forced market sell pushes the price down just a fraction of a percent.
But that drop is enough to trigger the next person's liquidation.
Exactly. Which triggers another market sell, which hits the next group of stop losses. It is a cascading avalanche.
It really is.
The smart money knows this domino effect exists, so they just give the market a little shove downward and let the retail liquidations do all the heavy lifting for them.
And the institutions just ride that downward pressure effortlessly, buying up the violently discounted assets that retail traders are being forced to sell at a loss.
Here's where it gets really interesting, though, because if these algorithmic spoofing walls and liquidation cascades are a known reality, why do people keep falling into the wood chipper?
That is the million-dollar question, or $1 billion in this case.
Right. Simon mapped out a fractal, a repeating historical pattern, comparing our current market action to exactly what happened back in 2022. It is uncanny.
It's almost identical.
In 2022, we saw a massive wick down to a major support level, followed by a long period of sideways, boring consolidation. Then, out of nowhere, a sudden green bull trap pushed the price up, which ultimately ended in a shooting star candlestick right before the floor fell out.
And the structural geometry in the chart today is nearly identical to that. But Simon noted one highly significant difference that tells us everything about who we are trading against.
What's that?
The consolidation period. In 2022, that boring sideways movement before the trap was sprung took 2 weeks. This time it took 3 weeks.
So they stretched it out.
Exactly. That extended timeline happens because there is vastly smarter money involved in Bitcoin today compared to years ago. Institutional algorithms use execution strategies like time-weighted average price.
Ah, TWAP.
Right. They don't just dump or buy all at once. They chop their massive orders into thousands of microtransactions executed over weeks. This artificially dampens the volatility. It creates a flat, boring market that slowly drains the retail trader's patience.
It actively weaponizes our own psychology against us.
100%.
Retail traders endure weeks of this painfully boring sideways chop. They check their phones 100 times a day and nothing is moving. So the absolute second they see a strong green candle finally breaking out of that flat line, their FOMO takes complete control.
Fear of missing out is a powerful drug.
It hijacks their nervous system. They suffer from recency bias mixed with a heavy dose of hopium. They want to believe the pain of the chop is over so badly that they completely ignore the structural warning.
They ignore the empty fuel tank.
Yes. Simon used the MACD indicator in his analysis to illustrate this brilliantly.
Yeah, the MACD histogram was showing a severe bearish divergence. To translate the mechanics of that, the actual price of Bitcoin was making higher highs, flying upward like an airplane climbing in altitude.
Right.
But the MACD, which measures the underlying momentum, the fuel gauge, was dropping rapidly, making lower highs.
And you cannot cheat physics. If a pilot pitches the nose of the airplane up and keeps climbing, but the engines are actively sputtering out of fuel, it doesn't matter how beautiful the view is from the window.
Gravity's gonna win.
Once that fuel line runs completely dry, gravity inevitably takes over. And gravity in the crypto market is absolute and ruthless.
We really need to emphasize that it isn't just beginners who get caught in this gravity well. Highly experienced traders, people who have spent years learning how to read these exact momentum indicators, get trapped here too.
Wait, really? Even the pros?
Oh, absolutely. They see the price climbing, they feel the adrenaline of the crowd on social media, and they actively talk themselves out of trusting the bearish divergence. They rationalize it.
That makes total sense.
This is the fundamental reason my crypto paradise exists. The Paradise team acts as an objective, mathematical shield, keeping the family protected from that mass hysteria and emotional rationalization when the market starts playing tricks on your eyes.
But wait, let me push back for a second. Isn't crypto supposed to be exciting? I mean, the whole industry markets itself on adrenaline, massive volatility, and overnight millionaires.
Sure, that's the marketing.
Right. If we strip all that thrill away and just look at boring divergences and math, aren't we killing the magic that brings people to the space?
I completely understand why you'd think that, because the industry profits off selling you that exact thrill. But relying on excitement is precisely the mechanism that bankrupts the retail trader.
Okay, fair point.
Think about how a casino actually operates. The gambler, the retail trader, pays dearly for the thrill, the free drinks, the adrenaline, and the flashing lights of the spinning roulette wheel.
They want the dopamine hit.
Exactly. They ride a massive emotional high when they win and a devastating crash when they lose. But the casino owner isn't sweating at the roulette table.
No, they are in the back room.
The casino owner is sitting in a quiet, boring, air-conditioned back office, relying entirely on the relentlessly profitable math of the house edge. They do not care about the outcome of a single exciting spin of the wheel because they know the mathematical probabilities are stacked in their favor over 10,000 spins.
So true.
We are looking at Simon's data to learn how to be the house, not the gambler.
The gambler inevitably washes out. Simon warned that treating the market like a casino trading without a system, relying on gut feelings and FOMO, will strip a trader of all their capital within 3 years. Guaranteed.
It's a statistical certainty.
Yeah. The Paradise Team methodology isn't trying to make you a better gambler. It's giving you the blueprints to build your own casino.
If we connect this to the bigger picture, true generational financial freedom does not come from adrenaline rushes. Adrenaline actively clouds cognitive function.
It makes you stupid, honestly.
It really does. True wealth comes from the incredibly boring, repetitive execution of a proven system. In this industry, consistency is the ultimate flex.
I love that. Consistency is the ultimate flex.
The professional hedge fund approach that Simon outlines relies entirely on identifying probability points. You do not risk your heavy capital just because a green breakout candle makes your heart beat faster. You only risk capital when the market structure is mathematically confirmed.
Which means waiting for the market to prove itself. You wait for a major resistance level to be broken, and more importantly, you wait for the price to come back down and retest that level to mathematically confirm it has flipped into a solid floor of support.
Exactly right.
Until that specific confirmation happens, the preservation of your capital is your absolute, non-negotiable priority.
That is why, right now, despite the temporary flashes of green on the chart, Simon is strictly utilizing bearish tactics.
He is not buying the hype.
Not for a second. He is looking downward, eyeing major, heavily calculated structural support levels at $55,000, $49,000, and ultimately all the way down to $44,000.
Wow, so he has targets stacked all the way down.
He is maintaining a defensive posture until the bulls can actually provide the mathematical proof that they have taken control of the trend. He isn't guessing. He is simply letting the market reveal its hand.
It's one thing to understand this casino owner concept intellectually while listening to us. It's an entirely different beast to actually execute it when the charts are bleeding red and your portfolio is dropping.
Oh, absolutely. The emotional toll is real.
To survive that pressure, you have to adopt the core operating philosophy, the paradise mindset. Simon shared his personal trading mantra in this breakdown, and I want you, the listener, to internalize this. This is the code that protects the family.
It is so important.
Simon says, I'm thinking probabilities, not emotions. I remain calm and disciplined in every market condition. I follow my trading system with precision and patience, waiting only for high probability setups. I respect risk management and protect my capital above all else.
This raises an important question, though. How do we actually overwrite our deep-seated biological wiring to achieve that state of robotic calm?
Because it goes against human nature.
Completely. Because humans are naturally severely loss-averse. Behavioral science proves that the psychological pain of losing $100 feels roughly twice as intense as the joy of making that exact same $100.
We are physically terrified of taking a loss.
That fear paralyzes us. It makes us hold on to losing trades far too long, moving our stop losses further down, praying to the market that the price will bounce back.
Which is the ultimate hopium trap. You freeze like a deer in the headlights while the algorithmic truck just runs you over.
The psychological cheat code, the complete mental reframe that separates the 1% of consistent winners from the 99% of losers, is found in how you define the concept of a loss.
Right.
Simon's mantra dictates that losses are simply feedback that sharpen the strategy, and wins are just the result of disciplined execution. A financial loss is not a reflection of your intelligence.
It is not a personal failure.
Exactly. It is simply a business expense. You are paying a small, strictly managed amount of capital to buy data from the market. That data tells you, hey, the market conditions have shifted, and this specific setup is no longer valid.
You detach your ego from the outcome entirely. But we know how incredibly difficult it is to build that mental fortress alone in your living room.
It's nearly impossible for most people.
That is the true value of my crypto paradise. We aren't just dropping arbitrary price targets on a chart and wishing you good luck. We are actively holding your hand through the psychological turbulence.
We really are.
We are here to help you rewire your mind, to build that emotional armor so that when the whales spoof the order books and trigger a billion-dollar liquidation cascade, you do not become their liquidity. You stay safe, you stay protected, and you stay consistently profitable.
The market will always present another high-probability opportunity tomorrow, next week, or next month. But if you lose your capital today by acting on pure emotion, you simply won't have a seat at the table to catch the next wave.
So let's bring all of this together. We've covered a massive amount of technical and psychological ground today.
We really have.
We started by dissecting the mechanics of creditor and herd dynamics, exposing the algorithmic spoofing traps and the biological illusion of safety around that $74,000 mark.
Yeah, that $43 million sell wall.
Right. We mapped the 2022 fractal, unpacking how institutional algorithms stretch time to weaponize your patience. We realized that when the market's airplane is completely out of fuel on the MACD momentum gauge, gravity is going to win, regardless of how bright green the FOMO candles look.
Gravity always wins.
Always. And most importantly, we broke down the vital shift from being a chaotic, thrill-seeking casino gambler to becoming a disciplined, boring, but relentlessly profitable professional who views losses purely as data.
It's a complete paradigm shift. It takes the power out of the hands of the market manipulators and puts it squarely back into your own hands. You stop reacting to the market, and you start dictating your own terms of engagement.
So, what does this all mean? It means that in the hyper-volatile world of cryptocurrency, your emotional control is infinitely more valuable than the most expensive, sophisticated charting software money can buy.
Without absolute emotional discipline, the greatest technical strategy in the world is completely useless.
Which leaves us with one final, crucial thought for you to take with you today. We've spent this entire deep dive talking about the vulnerabilities of human psychology, how our herd mentality, our impatience, and our loss aversion make us easy prey for institutional algorithms. But consider the trajectory of this technology.
Where it's heading.
Wall Street is pouring billions into the space, and algorithmic trading is evolving into deep machine learning. As artificial intelligence begins to completely take over the order books, running the casino with flawless, emotionless precision, what happens to the human trader?
That is a scary thought.
Will we eventually reach a point where human emotion becomes permanent, unavoidable liquidity for the machines, or will the disciplined, calculated mindset we discussed today be the one human trait that the algorithms can't exploit? Think about what side of that equation you want to be on. Thank you so much for joining us on this deep dive, and welcome to the family.